Whether we own and operate a Thai restaurant, a shooting gallery, a movie theater, or whatever our business, a knowledge of the nature of our costs is critical. Fixed and variable costs are incredibly useful in examining the relationship between our costs, our volume, the number of customers, and our profits. This analysis, not surprisingly called cost volume profit or CVP analysis, is an important part of managerial accounting. CVP analysis can help managers assess the impact that a particular action will have on profitability. CVP analysis involves studying the interrelationships among revenues, costs, levels of activity, and profits. A lot of what is done in management accounting involves some aspect of CVP analysis because of the tremendous potential it has to help management increase the profitability and effectiveness of an organization. To review, a cost may be classified as either fixed or variable by the way it reacts to changes in level of activity. Think of a donut shop like Krispy Kreme or Winchell's. As more donuts are sold, the total cost of donut ingredients increases. This is a variable cost. On the other hand, the cost of property taxes does not increase as more donuts are sold. This is a fixed cost. However, there are costs that have both variable and fixed components. For instance, the electricity cost to run the donut shop will increase as we sell more donuts because of the cost of the additional power to make those donuts. But even if we don't sell any donuts, we will have to pay some utility costs just to keep the shop open. Utility costs are a mixed cost. Now, the cost of a supervisor's salary isn't normally going to increase as we sell more donuts until we have so many customers that we need to hire an additional supervisor to help with the higher volume. At this point, the fixed cost of salaries will jump to a new level. This is an example of a stepped cost. Overall, once we have defined the activity, measurements of change in activity level can be used to determine cost behavior patterns. Now that we have reviewed cost behaviors and understand that mixed costs can be separated into their fixed and variable cost elements, you are ready to use your knowledge of cost behaviors to make planning decisions. Think of an actual business organization that's familiar to you, perhaps one by which you've been employed or are now employed. Think about the product or service this organization creates and the costs and processes it uses. As we study the CVP analysis method, be sure to consider how this tool would be used in your own organization to plan and manage costs and activities in order to obtain desired results. In order to effectively use CVP analysis, we first need to spend some time working with the concept of contribution margin. Contribution margin is equal to sales revenues less variable costs. It is the amount of revenue that remains to cover fixed costs and provide a profit for an organization. For example, the contribution margin from the sale of one order of French fries by a fast food restaurant is the selling price less the variable cost of producing the fries. Any contribution margin generated by the sale of French fries can be used to pay the fixed costs of the fast food outlet, like monthly rent, insurance, and supervisor salaries. Again, contribution margin is sales less all variable costs. Contribution margin is one of the most important management accounting concepts you will learn because many operating decisions are made on the basis of how contribution margin will be affected.